And we're talking about my exact ETF strategy that I use to build a long-term portfolio, even through the bad times, the good times, all the crashes. This is what I use and my own personal ETF and index fund portfolio. So I want to share this with you guys. It's more about how I specifically structure my money in real life, okay, across two different primary platforms for ETFs and index funds. Now, before I show you anything on the screen or we start talking in depth, I want to clear just something up right up front. I just need you guys to know that of my entire portfolio, a network approaching 2 million or what have you, only about 1%, a little over 1% maybe, of my total portfolio is in individual single stocks. So the vast majority of my investments in the stock market is ETFs and index funds. And that's not by accident, okay? That's not because I don't like individual stocks. You know, there's a place for them as well, but it's really because I don't like a whole lot of risk in the stock market, to be honest with you. Although when you look at my portfolio, there'll be some risk and you'll be like, oh, okay, he's kind of stepping out on a limb there. But it's mainly because I understand my risk tolerance level. I understand behavior and probability and all that good stuff. So the largest portion of my entire portfolio is in what's called a TSP because I work for the federal government. The federal government has a thrift savings plan called a TSP that offers 5 or 6 funds that essentially those 5 or 6 funds in the government's TSP are really just like low cost index funds. Is what they really are. So overall, guys, a majority of my wealth is built through ETFs and index funds. And then a nice chunk, a portion, maybe somewhere around 28, 29% of my overall net worth is in real estate. Okay. And then, of course, I have some cash and bonds for stability as well in my portfolio. So I'm talking specifically about my portfolio and why it's structured the way it's structured. And I've been investing for decades, guys. So what I'm sharing, I give all that up front to say what I'm sharing tonight, guys, is not theory. It's not hype. It's not something that I learned just last year. It's what actually has stuck over time. So portfolio one, let's talk about portfolio one. The first portfolio is my Fidelity portfolio. The Fidelity portfolio has about $75,000 in it, roughly. And I'm being transparent just to let you guys know. This is if something goes wrong with YouTube or if something goes wrong this will continue to pay me. That's the job of this particular portfolio. It's about stability, it's about balance, and it's about behavior. This is my Fidelity is sort of my sleep well portfolio in terms of ETFs and index funds. The second portfolio I have in terms of ETFs and index funds is Vanguard. Right now, it's only about $25,000, but it's growing by a lot more than Fidelity every single month. This portfolio at Vanguard is more my growth engine. It's the thing I'm pushing to actually see growth. So we take a little more chances, a little more risky, et cetera, than with the Fidelity. So this Vanguard portfolio, it has larger monthly contributions, so it's going to grow more. It has some intentional tilts here and there, right? And you'll see it in a moment. But it's about long-term compounding. Frankly, guys, of all these ETFs and index funds I'm going to show you in these two portfolios, you're going to say, wow, this is a lot. Why do you have so many? Because I'm doing different jobs. And of course, I talk about money all the time. So I love this stuff and it's something that I do all the time. And so I'm into it. This particular portfolio, the Fidelity piece, and we're going to go over the Vanguard piece up top here in just a little bit. But let's start with the Fidelity piece. Just so you know, and it's not depicted here on the screen, I do keep a little bit of cash over in the Fidelity account. Not a whole lot in this account, maybe, $1,500, $1,000, $1,500, just a little play money. So the first one here on the screen I want to kind of mention is FBALX. FBALX. This is the Fidelity Balanced Fund. This is a mutual fund, by the way. This is the only mutual fund in my entire portfolio. By the way, 25% of my money goes into roughly 25% goes into each one of these every time I make a deposit, and then I'll be rebalancing them. I've had this fund about a year, so I'll be rebalancing these as well here shortly. Haven't done it yet, but I will. This particular fund, this one, FBALX, is there to sort of like, it's a chill fund. It's sort of lower volatility. It's not an exciting fund. It's nothing like, whoa, this is, no. It's been rated by Morningstar with 5 stars. So that's always fun. That's always good. But this is a mutual fund. The difference between mutual funds and index funds is mutual funds are actively managed, okay? So this is an actively managed fund, so the fees are a little bit higher, but it's really an income and a capital growth fund because about 60% of it is stocks and about 40% of it is more fixed income bonds. This is my chill fund. It has very low volatility. Again, it's not an exciting fund to have, but that's why it works, and that's why I keep it as 25% of this particular portfolio here over at Fidelity. Now, the next one, and I'm going to go through each one of these guys real briefly. The next one is FDVV. That's the high dividend. That's an ETF. It's a high dividend ETF. And with all of my dividends on all of my money at all of the portfolios I have, I always make sure they're reinvested, okay? So I'm not chasing a dividend yield on FDVV. I'm just sort of managing volatility. This one invests sort of in large and mid caps type of stocks or companies are in the bucket. It's got a few international, not much. I don't dibble and dabble in too much international, okay? But it's really focused on companies that have a strong dividend growth. It does tilt towards the technology sector and the financial sector. Now, the next fund that I own over here in this particular portfolio is FNDX. That's a large cap value, and it's actually offered by Schwab, but I went ahead and bought it on Fidelity. And it's really it's one of my favorites, one I like. It doesn't weight companies just by how hyped they are. And this fund seeks to kind of purchase companies, value companies. And whenever you hear the word value versus growth, we're talking about stable firms, profitable, old school, stable companies, your AT&Ts, for example, right? So large cap value is FNDX. It doesn't use the usual market capitalization approach. Solid, very, very solid, something you can check out. Pretty low expense ratio on this one as well. Now, the final one, remember what I said about this Fidelity. This Fidelity is more my chill. If something happens to YouTube, if something happens with one of my other income streams, this fund is kind of that steady thing. Not a whole lot of volatility in this one. It's got a little bit of volatility with FBALX, a little bit, but not a whole lot. Notice that none of these funds say, other than a little bit of FBALX, says growth. Most of them are value. That means that they're steady, less volatility. Value, large cap value, dividends, and then you got your large cap blend, but it's 40% of bonds. There's not a lot of risk in this particular portfolio because the final one, FXNAX, is a bond index fund. So you're talking about bonds. Again, low volatility. Got some MBSs in there, mortgage-backed securities, got some treasuries in there. And again, we know bonds don't make you rich. Look at this, 25% of the portfolio is bonds. Over here, Fidelity is bonds, less volatility, smoother ride, control of emotions. This Fidelity portfolio of mine is built to survive a lot of bad years, which I don't know if you guys know this or not, have been looking or been paying attention, but 2023, the S&P 500 was the average rate of return for the year was about 22, 23%, somewhere around there. 2024, again, around 22, 23%, somewhere in there. 2025, around a little under 17%, the S&P 500. So we've had 20-something, 17 in the last 3 years. 2026 is expected to be a pretty decent year as well. Maybe not so high, but again, we may have some years coming up where you need something, a piece of your portfolio to sort of right the ship a little bit. This is why I have this Fidelity fund, because I want to be straight just in case we have a few bad years. 2026 might yield us an S&P 500 average return of 12%, 13%, 10%. But hey, 2028 and 2027, 2029, we may be looking at 3%, negative 2%. 2022, we had negative something percent. So I'm just preparing, and that's what this portfolio is all about, is to sort of prepare for the down years, for the issues, the problems. That's the Fidelity portfolio. Quick pause, because I always forget this and people have to remind me. And so I'm going to do it here, but just want to let you know, but we're doing a 4 steps financial reset. The enrollment just opened yesterday. For February, we're doing 3 open live Q&A sessions. Plus, you have full access to the 4 steps to maximize your money course that has over 120 reflection questions, has 16 fillable handouts. So you get all of that, plus nearly 4 hours of instructions. You get all of that, plus you get access to the 3 live Q&As we're going to do. What I'm trying to do is I'm trying to take what I do on YouTube, take it off of YouTube, and let's go ahead and really touch people with their money in a more meaningful way, right? Where we can actually sit down. You can ask me questions about your portfolio, what you have, what you should do, what you shouldn't do. You know, we can kind of touch people where they are instead of giving these high level YouTube videos. So the link, the 4-step financial reset, that's going to be below. So it'll be in the description box. It's a structured, practical, no hype, no shortcuts system. And then if you want the mindset behind everything we do, you can check out the book. This book is as little as $2.99 on Kindle right now, the Kindle version, but it's also offered in paperback and hardback. This is the Manage Your Way to Millions book. You can go to manageyourwaytomillions.com and check it out, right? No pressure. I'm just making sure that I give you tools, not just words, not just videos, right? But actual tools that you can use. You can highlight, you can get out a pencil and paper, you can write, you can take notes, right? Because we want to really help people. Now, why index funds and ETFs over single stocks for the most part in my portfolio? Well, here's the uncomfortable truth that a lot of people don't really want to hear. Single stock investing or individual stock investing requires you to be right in a lot of different places. You have to pick the right company. That means you got to do your due diligence. You got to review balance sheets, not necessarily balance sheets. You can read the summary of balance sheets and all that good stuff. You can go on Yahoo Finance and so forth and get the summary of them. So you don't necessarily have to read 10Ks and 10Qs of individual companies, but it requires that you have to do your due diligence and pick the right company. That's the first thing you got to get right. The second thing you got to get right when you're investing in individual stocks is you have to invest in them at the right time and at the right price per share. And then here's the big one that a lot of people mess up when they're doing individual stocks. And this is all why only 1% of my portfolio is in individual stocks. But the final thing is that you have to sell at the right time. You can hold forever, but most companies have a shelf life, right? So you have to pick the right stock at the right time, at the right price, and then sell it at the right time. All the while, when you're picking individual stocks, you got to control your emotions. You can't get too hyped. You can't get too down. You can't get too fearful, too scared. All of those things is difficult for 99% of everybody walking the planet. Okay. And so when you're investing in individual stocks, it's not really investing to me. It's more like predicting. It's more like guessing. And that's why I say you got to be careful with individual stocks. Most of us should be in the index fund ETF game, right? ETFs and index funds removes most of that predicting, most of that guessing. See, I don't have to predict which company is going to win when I invest in an ETF or index funds. I'm buying a bucket of stocks and I let the market sort of do that for me. The market dictates when a company gets in that bucket and when a company leaves that bucket. It's very important to understand that concept. And once you understand that, the question stops being, how do I beat the stock market, right? And becomes more like, how do I stay invested in the stock market long enough to actually win and come out ahead? The goal here is just getting clear and clarity. And you could turn around and you could use my strategies, or you could use my thought process and help form your own thought process. Most people lose with individual stocks. It's not because they're dumb or they're incompetent or ignorant. Most people lose with individual stocks because they are just human. And it's the human emotion that trips everybody up when they have these individual stocks. There's too many decisions. There's too much emotion. There's no real, most people, not everybody, but most people don't have a real system, don't have a real philosophy, don't have a real core strategy. For a lot of you guys, stock picking feels productive, like you're getting something done. Stock picking for a lot of people, it feels exciting. Ooh, yeah. Ooh, I picked that stock. Ooh, that's always what happens until you watch a stock go down in value while you still holding on to 100 shares of it, right? That's not a good feeling. ETFs and index funds, they work better because again, they remove the guessing, remove the prediction. I'm trying to hone in on this so you guys really get this piece here. They reduce your decision making. That makes it easier. That makes it a little less friction because they reduce the decisions that you have to make. And it also removes some of the emotions when you don't have so many decisions to make. You got 10 choices. It's more difficult than if you got 2. I have 2 additional outside portfolios other than my thrift savings plan. So I have a TSP, thrift savings plan with the federal government, which has a bulk of the money that I have in stocks, right? ETFs, index funds, and stocks. Outside of that, I've really got 3 portfolios, but I have 2 that are index funds and ETFs. The other one is an individual single stock portfolio. But these 2 ETF and index fund portfolios are designed to do 2 different things. Very important. 2 different things that's separate from my TSP. So one mistake that a lot of people sort of make is trying to force one portfolio to do everything. You don't really have to do that. You can have, now you don't have to have 5 and 6 and 10 different portfolios, but if you got 2 or 3 different portfolios, there's nothing wrong with that because you might have 2 different jobs for them, which is what I do, right? Now, let's talk Vanguard, okay? Now, the Vanguard portfolio, this is my growth engine portfolio. So let me see if I can't share my screen again. How do I do that? I'm going to figure it out. I promise you. There we go. All right. So now let's move. This is Fidelity at the bottom down here, right? I even got some things I'm watching over here. But then up here, and this is my actual spreadsheet, all right? This is not something that I made up just for the video. This is the actual spreadsheet that I follow. So, and by the way, notice I'm putting only a couple of $100 a month right now in Fidelity. Sometimes that's a little more than that. Sometimes it's a little more than that, $300 or $400, $500, $600. But in the Vanguard, I'm putting about $1,000 a month. The Vanguard portfolio right now is actually less. It's only $25,000, but that's growing every month. And I left this column up here. I want you guys to notice this column. This is where I was in 2025. And I wasn't putting a full $1,000 every month in 2025, but for a lot of months. So this was 2025. This over here, this column is 2026. Okay, so we made some changes. So, and by the way, you'll see on this left column here, that's just some things that I look at when I'm looking at ETFs and index funds. Okay, so let's kind of go down the list in terms of this particular portfolio. This is where long-term compounding is going to happen and growth. By the way, this fund is broken down into 53% growth, about 37% value, and about 10% bonds. Notice in every single portfolio I do have it balanced with some bonds. Even in my TSP with the federal government, I'm about 90-10 or 80-20. I'm sorry, 80-20. 80% securities, 20% bonds. In Fidelity, I was what? 75% securities, 25% bonds. Up here in the Vanguard, that's more of a growth, I'm still about 10% in short-term treasuries, okay, right here. So I always have a mix between those. Maybe call it my risk-averse personality or tolerance level, but that I kind of like to have a little bit of bonds in there as well for some of the stability, even out the bumps a little bit, even though there's not a lot of volatility in any of these, but there's some in this one. So 53% growth, about 37% value, and about 10% bonds, but heavy on the growth in this Vanguard account, being intentional. Now, here's the deal. This is what works for me. You don't have to copy what I copy, but I'm giving you the thought process to how I think. And therefore, you can use this as a model or as some things to think about for your own strategy, your own portfolio or portfolios, right? So I have growth in this particular Vanguard. I want to live on the edge a little bit over here, right? I want to live on the edge a little bit over here. So I'm tilted towards growth, which I'm tilted towards growth in all of my portfolios. So, I'm also tilted a little tech heavy in all of them as well. And I'll talk about that in a bit. The value of this portfolio at Vanguard is to control some of the volatility of the growth. And then, of course, the bonds, again, is to smooth things out sort of for stability. Here's one rule that I use in this particular portfolio. And yeah, let me say this before I go further. There is a little bit of overlap in this particular portfolio. Totally understand it. Anytime you have the S&P 500 as your staple, it's going to overlap, especially if you have some of the big boys in other parts of your portfolio. If you got some Eli Lilly in other parts of your portfolio, you're going to get some overlap. If you got some Meta, and you got some Alphabet, and you got some Tesla in other parts of your portfolio, there'll be some overlap. But I do like a broad ETF or index fund as sort of my foundation of the portfolio. If you look at my TSP portfolio over at with the federal government, I've got the C fund. A lot of my money is in the C fund, which is the S&P 500. So even over here, I'm still at that same mindset, having a broad foundation with a broad-based index fund or ETF. In this case, it's an index fund. It's a core large cap growth fund. I got the S&P 500, VFIAX. It's the foundation. It's the backbone. It's where 30% of the portfolio goes into this particular fund. It's super low cost. It's an index fund, super low cost, broad exposure to the largest companies in America, the top 500 plus. I think it's 515, 520. But it has a proven long-term history of compounding. Now, let me share this screen with you guys real quick. I told you we're taking our time here, guys. This is no rush. Okay, so VFIAX. This is a core staple of this particular Vanguard portfolio of mine. Small expense ratio, tiny. Index funds are a little different than ETFs because sometimes index funds, they take a larger initial investment. This particular fund, you got to start with $3,000. You got to jump in it with $3,000. Now, I'm not going to look at all these things, but I do want to look at the current price. It's currently trading at $638. It's not trading. It's an index fund, so it's not trading, but it's at $638.50. Looking at some of the performers, again, I'm not going to go through all these for each one of these, but I just want to show you a little bit about them. The 1 year performance, 17.83%. 3 year, 23%. 5 year, a little over 14%. 10 year, almost 15%. Since inception, under 9%. For a 10 year, that ain't bad. 15% is not bad at all. Now, again, there's other things I look at besides performance, guys, but I just want to kind of show you that. If you notice something back on the spreadsheet, I reduced it from 40% down to 30% this year. Not because I stopped believing in the S&P 500, it's because the S&P 500 has become very, very concentrated. What is the S&P concentrated with? Well, technology. 30+%, 37, 38% of the S&P 500 is technology. And I already told you, I already have a bunch of S&P 500 over at my thrift savings plan. So therefore, and if you look back at Fidelity has some growth in there as well, and has some of those technology, Mag 7 companies in it. So because the S&P 500 has been concentrated with tech and some of the mega cap tech companies driving a large portion of their returns, I said, you know what? I need to kind of start right sizing this thing, pulling out of tech, which I tell, every other people to do all the time. And so if you look at the portfolio composition here, information technology makes up 34% of this particular fund, this index fund that tracks the S&P 500. 34% is IT, 13% is financials, and 10% is consumer. These are the different sectors: consumer discretionary and communication. The top holdings in and of themselves: Nvidia, Apple. This is the Mag 7, right? 1, 2, 3, 4, 5, 6, 7. Meta's just out of it, but they'll be back in it shortly. Broadcom has bumped up to the Mag 7. But this is all technology other than Berkshire. Just a handful of companies are driving this thing. So this fund still gives me economic growth, gives me market leadership in the big boys, gives me long-term compounding, gives me lots of tech exposure, but I needed to reduce it to solve some of my concentration risk. I'm not chasing returns, guys. I'm trying to manage some risk. Now let's go to the next one. Actually, I'll go to the next one on my spreadsheet. I don't know if you noticed this or not, but on my spreadsheet, I crossed out VYM. I got rid of my shares of VYM, and I'm going to use those shares to actually invest in some of the other ETFs that I have here in Vanguard. I'm not going to use those shares of VYM that I got rid of to invest in the S&P 500 because, again, I'm sort of overstretched that way. So I want to balance it out, and I'll be putting some of that money from the VYM that I sold or got rid of into some of the other ETFs that I'll show you here in just a moment. All right, back over here. Again, that's where I crossed out VYM. But next, let's go to mid-cap growth. Mid-cap growth is VOT. This fund was 13% of my portfolio. I moved it over to 15% of my portfolio. Mid-cap companies are sort of a sweet spot. They're past small cap. Oh, can we just survive as a company? They're still usually in early expansion as a company, and they often grow faster than mega caps, right? Small cap, mid cap, large cap, large cap, large company, mid cap, middle-sized company, small cap, small company. So this ETF, this is an ETF. This ETF is a bucket of stocks filled with some of these mid-cap companies. And I intentionally add more into this piece of the pie here, this mid-cap. So VOT is about 15% of my portfolio. Let me see if I can't show you that real quick. So VOT, again, just want to show you this real quick. It's a mid-cap growth, a little bit higher expense ratio, but still very small, very, very little. It's an ETF. And so it's about $283 per share right now. And if you look at portfolio composition, sort of what's in it, it's filled with 20% of consumer discretionary. What is consumer discretionary? Nike, right? That would be a consumer discretionary. It's got about still almost 20% tech, 22% industrials. Some of the top holding companies is Constellation Energy, Robinhood Markets, DoorDash is in there, and so forth. Motorola, Quanta. Again, these are mid-level companies geared towards growth, expected to grow. Next one on my list, guys, is VBR. VBR is a small cap value. So VBR is a small cap value. Again, the word value, not growth. Pretty low expense ratio. In terms of portfolio, what's in the bucket? What's in the bucket is mostly industrials, a lot of financials, and a lot of consumers. Again, these are smaller companies. I moved this from 14% to 15% of my portfolio. Small caps is volatile. Small caps ain't done super duper well in the last 15 years or so. This is why I did not go small cap growth. Small cap growth would be more volatile. Growth is always more volatile than value. So small cap growth would have been off the charts, right? Small cap value, still kind of volatility, but not so much. Small cap can underperform for long stretches, but it stays in my portfolio because historically it gives me some diversification. It gives me long-term. Small cap is always a long-term, but it gives me exposure to parts of the economy that large companies don't give me. So small cap is about patience. That's why it's only about 15% of the portfolio. The next one in the portfolio is VGSH. Again, this is my 10% bonds, and I'm not going to go specifically to that particular one, but it's bonds. I keep 10% in these short-term bonds. It doesn't change. It's just a staple in my portfolio. Not chasing yields, trying to reduce some volatility. Same reasons I have bonds in the Fidelity portfolio. They're not going to make me rich, but they're going to be there to kind of smooth out the rough parts. Now, let's talk about some of these sector ETFs, sector-specific ETFs. We got financials, VFH. And when we say sector-specific, we're talking about specific sectors that I like. Because I like money and deal with money and on a regular basis, I wanted to have a money ETF. Fairly low expense ratio still. Looking at the portfolio of what's in this particular portfolio, what's in this bucket, I should say, about 20%. Where's it at here? I think I just had it. 22% is the diversified banks. About 10% is investment banking and brokerage, and about 15% is payment processing, the PayPals and so forth. 8% is property and casualty insurance. So I have in this particular portfolio, about 5% of my portfolio goes towards Vanguard Financials, VFH. What this fund does for me, this bucket of stocks, it adds exposure to a piece of the stock market that usually does different. It behaves differently than tech, right? Or growth stocks. So it sort of balances that out. Now, the other one I have, the other sector specific I have over in Vanguard is VNQ. Now, VNQ is real estate. That's a REIT, right? So a higher expense ratio. Now, what is in this particular portfolio? 13% retail REITs, 11% industrial REITs, but a 15% healthcare REITs, 8%, almost 9% in data center real estate investment trusts, right? 8%, almost 9% in real estate services, almost 10% in telecom tower REITs. So this is all about real estate investment trusts. This is sort of a change for me, guys. I increased the allocation from 5% to 15%. Why? Because real estate provides me inflation protection. As we know, oftentimes stock market goes down, real estate goes up. That's kind of a pattern, right? It also gives me more real estate. I also own some physical real estate. Since I've owned physical real estate for more than 25 years, I like real estate. It's also a little diversification from traditional buckets of stocks, because now I have buckets of real estate, a bucket full of different types of real estate, right? This is not about me trying to time the real estate market, none of that. This is about me just acknowledging the fact that real estate behaves differently than typically paper assets, right? And real estate is also a hedge against inflation. So when we have high inflationary periods, we know that our real estate is going to maintain during those high periods of inflation, and gives me some diversification. Now watch this strange move with my last sector specific. And you're going to say, wow, that's a strange move. You just replaced what you got rid of in terms of your S&P 500. You just added it back in. But my other sector specific is technology. Well, man, you are sitting here, you're contradicting yourself, right? Well, here's the deal with technology. I am moving out of technology in other areas, right? When we look at my individual stock portfolio, moving out of it. When you look at rebalancing of this particular portfolio, moving out of it. But man, I could not resist the urge to get a little bit of this VGT, a tiny percentage. And when I say a tiny percentage, we're talking 10% of the portfolio. And I may flip-flop this and go to 5% in here and 10% in financials. But for right now, 10% into Vanguard's technology ETF. What's in there? Well, it's technology. It's 32% in terms of semiconductors, 17% is in terms of hardware, storage, et cetera, 14% in application software. And let's look at the performance, okay? The performance is one of the reasons, guys, that I say, well, let me still stick around 10% over here in VGT. Because if you look at the 5-year and look at the 10-year performance of this particular ETF, you're talking 22, nearly 23% over the course of 10 years. And if you look at the 5-year stretch, the 5-year stretch includes the down year of 2022, when the entire stock market was way down. So even with that way down year in 2022, still returned over 17% in 5 years, 33%, 34% in 3 years. So when you look at those type of returns, I know 10% of my portfolio, but guess what? It'll probably be 5%. I'll probably move it to 5%. And I'm not necessarily trying to chase performance on this, okay? Again, I've got a lot of technology in my S&P 500s, but it's an intentional tilt with this particular ETF to tilt towards AI, to tilt towards software, data, automation. I believe that's the growth, the future growth. I don't see a slowdown there. And so if nothing else, keeping about 5 to 10% in VGT gives me some of that future growth exposure to a greater extent than just having it in the S&P 500. Again, intentional, not an accident. When you step back, sort of, that's sort of my portfolio, guys, in terms of these two. So when you step back and look at the Vanguard portfolio, you see growth, but diversified. You also see value. You also see controlled bonds, and you see some sector tilts. Nothing super exciting. Everything here is about trying to survive. This portfolio here, Vanguard, is built to grow, but grow quietly and survive some volatility and keep me invested across several market classes, guys. That's the entire point. Now, why do I only have, this is my Vanguard and my Fidelity ETFs index funds. In that whole stack, you say, wow, that's a lot. That's some overlap and a lot of, you always tell us you only need 3 or 4 because for the average investor, you only need 2, 3, 4 ETFs index funds. But I've moved to the point where I'm beyond the average investor because I'm watching this stuff on a daily basis. And most people aren't doing that. So I got a lot of exposure to a lot of different buckets. I do have an individual stock portfolio that's a small piece of, again, only 1% of my overall equities, right? So the deal is this doesn't have to be your portfolio. You can take my thinking and start applying it in a way that's best for you in your portfolio, right? You don't have to have the same allocations that I have. The mind frame, the thought process is super important. I just want to share this information with you guys in a transparent way to say that this is my ETF index fund portfolios. So I'm building a system. What you need to do is consider building your own system. So no matter the amount of money you're working with is not an issue. The issue is, does it work for you? Does it support your goals, your long-term goals, right? Does it support what you're trying to do with your personal finances over the next 2, 3, 5, 10, 15, 20 years or longer? If this video helped you see investing clearer and sort of see the types of things you need to do in terms of investing clearer, excellent. We've done our job. Start with structure. First, start with what are your core values, your core strategy, your core beliefs. What is your philosophy with investing? Are you okay with taking the risk of individual stocks? Or, how do you plan to look at ETFs? We looked at Fidelity, how we're allocated with the Fidelity. Again, these different accounts serve 2 different purposes. And then we looked at the Vanguard account up here. And then over here is my strategy. Low expense ratio, sort of a 90-10, right? Remember, 10% of this is bonds, sort of a 90-10, 90% equity, 10% bond. Allocation, what holdings, these are things I look at, what's in the bucket. I look at the specific sectors. I look at past performance. I look at the risk rating back on Vanguard. I look at how many stocks are in the bucket, right? And of course, the price and so forth. These are things that I look at. You got to figure out what's most important to you when you come up with your strategy. Super duper important that you figure that out, right? What's most important to you? By the way, that's what the 4 steps financial reset is really all about. It's helping you come up with your own strategy. And it's also what this Manage Your Way to Millions book is all about, helping you come to grips with who you are with money, not who Kramer is and not who Susie Orman is or Dave Ramsey or Smart Money Bro, but who are you in terms of your money? That's the key. If you got value from this, guys, do me a favor, smash that like button below. If you know of anybody who's a beginner investor, please share this information with that person, guys. Just click the share link of this video and just shoot it over to them so they can take a look at this information. This is basic information, but it's important information. All right, guys. As I always say, the absolute best person to take care of the old you is the young you. Until the next video, peace.